Okay, thank you for joining my LinkedIn live show. It's been a little while since I've done one. I did one a few weeks ago with RC Whalen from Institutional Risk Analysis, and now I've got another great guest coming today. But first, I just want to give some insights and thoughts what I'm seeing in the market. We're still on the property management side. We are still seeing uh, collections doing really well in the single family rentals, leads, and all this kind of stuff, which I'm going to get into, showing our website traffic and how well it's going, but really just talking about the market in general. And this is something that my guest and I, Issy Roman, are going to discuss in detail about what we're seeing in the market and the kind of migration patterns we're seeing, the things happening with renters, of the affordable housing, and how that is kind of being turned on its head. And it's funny because you see all of these things happen over decades, and this is a new decade, and we have a lot of new things happening in the housing markets around the country, especially in the urban areas. Um, so we're still focusing on really working with funds and builders to help them come together with JV agreements to build more affordable rentals and homes in these tertiary hipsterbia type markets. And we're seeing a lot of, there's a lot of talk out there and a lot of people trying to figure out what's going to happen with the housing market, what's going to happen with the economy. The funds that we advise, we're really looking at September, October to really start thinking about really what's going to be happening with rent collection. I think that's when the money starts to run out. That's when some forbearance issues start to come into play. And I think until then, we're going to see some pretty stable rent collections. As of May 14th, we've collected 88%, actually 89% of our rents, where typically we're at about 91%. So we're a couple of points off. And that goes for the same thing was happening in April. We're ahead of where we were in April, and we think we'll be at that 95% rent collected for May. Some people ask what we think is going to happen in June. There's no telling. I think there'll still be strong rent collection then as well. So I want to get right to the point. I want to bring my guest on. E.C. Roman is the founder and CEO of MetroSite. He's an economist. He was the chief economist for Trulia and Zillow at one point, and he's a great guest to have. So I'm going to bring EC in here. See if I can do this right. But it's exciting to have the guests that we have, and he's going to have a lot of great insights. So welcome to my show. You're welcome. You're welcome. It's great to have you. And we've got, we had some pretty good turnout for this, and really working on the LinkedIn Live and to LinkedIn adding the event possibility is great, because now we can see the people that are registered. They can interact with each other. If you're watching this, please comment, questions, insight, whether you agree with what we're saying or not. But first, let's talk a little bit about you. Tell me where you came from, what you're doing now. Let's start with what you're doing now. So what's your role now?
So I have two roles. I founded my own consulting firm at the very end of last year called MetroSite. We do a mix of work, public sector type economic analysis, data PR advisory, which means we help startups figure out how to do research for publicity. And my goal at the moment is to help advise investors on how to adjust what they're doing to the new world now that we've got this pandemic upon us, and we're probably at the beginning of a very different stretch in history. That means a lot in every different sector of real estate, helping people figure out how to adjust to that in a quantitative way with maps and data and such is where I'd like to take things. The second leg of what I do is semi-academic. I'm a fellow at the Turner Center for Housing Innovation at Berkeley, where we study all different aspects of housing. Right now, I'm working on a big project that's indirectly for the state of California to try and estimate how likely it is that every parcel in the state will get developed, and be able to use that in different ways to try and spur more housing in the state.
That's great. So, you have an interesting perspective on things, but let's talk a little bit about you. How did you get to what you're doing now? Tell me a little bit about your history, where you came from, um, and what drives you, and why you do what you do.
So I grew up in Israel. I was the child of a diplomat. So I was born in the U.S. Didn't get to live here very long, but came back in ninth and tenth grades, and lived in Texas, in Houston. And I have to tell you, Israel is a lot more like Europe than the U.S. in the sense that children can get around, they can get on a bus and get to places. They're not dependent on being driven around. Houston is the exact opposite of that. It's the most car dependent place in existence, just about. And that was kind of a formative experience for me. Just jarring to be moved to there just before the age of being able to drive, and that made me very interested in cities. Um, Everything about them just fascinated me. How people get around, where they're dense, where they're not, where they're headed, what they were like historically, and I wanted to study that. So I went out and studied architecture, and discovered that my way of thinking about things was more in line with the way an economist thinks than the way architects tend to think about things, and gradually switched and ended up coming back to the US to do my PhD in economics at Berkeley, and ended up staying here. So I found myself post school working for startups, first for a startup called BuildZoom for several years, and then later on as Truly as chief economist, doing what I call lay audience research, trying to get to the bottom of a question and writing it up in a way that people, not economists, can understand with real insight.
So that's much unlike what I see now. I mean, I see some good housing data that comes across, but I see also a lot of narratives that are being pushed for, I don't even know the reason. And I spend a lot of time debunking, and that's kind of how I got a lot of my following, doing these LinkedIn lives and doing things like that, was just really going out there and reading faulty interpretation of data and then debunking it. And recently I've had, so I'd like to jump into this because this is always a thought, always a question everyone has. It depending on where you read and the headline you read or the content. There's this fear that we're going into a period of time that we're going to see mass foreclosures and mass, declines in housing values. And I would like to understand how you look at it, but I look at it as those two aren't always related, right? So just because there's foreclosures doesn't mean there's going to be a huge decline in values, especially in a time now. Maybe let's talk about this. What is different in the climate today compared to 2008? I think I know the answer, but I'd like to really hear what your thoughts are, because that's really what people are fearful of. It's that narrative that's out there. It's the pain that they still felt, 10 years ago, and they're taking that experience and putting it into the box here, and it doesn't fit, in my opinion. Although we're in a very, very difficult time for a lot of people, and so I don't want to make light of that, but I think the housing dynamics are different as well. So I'd like to just get your general thoughts on that.
So 2008 is vastly different than what we're facing now. In 2008, we had a housing driven crisis. Housing was the epicenter of the problems at the time. Home sales had sped up dramatically. People were buying homes at increasingly high valuations with increasingly high leverage. And at the moment that that bubble was popped and housing prices dropped a little, there was a very large number of people who had bought very recently and were immediately underwater and immediately incentivized to stop paying, whether they could or couldn't, right? And at the point that all this rolled into the broader economy and people started losing jobs too, that created a snowball effect where people really couldn't pay and had to be foreclosed upon because they weren't able to make their payments. Right now, we're coming into this with a pretty healthy housing market. We're perhaps late in cycle. It's hard to, or we perhaps were late in cycle pre-pandemic. It's hard to say. The one thing that we know for sure now, as the pandemic is upon us, is that activity is freezing up. It's slowing down. We're seeing fewer listings go on the market. We're seeing fewer people apply for purchase mortgages. And all that is a clear reaction to the pandemic and to having to shelter in place and not wanting to engage with people physically. It's different than the usual slowdown in sales that often precedes falls in prices, because the usual slowdown in sale indicates that people are having a harder time selling and are gradually accepting the fact that they need to lower their prices. Whereas now there's a very clear reason for why people aren't putting their houses on the market, and it has nothing to do with how difficult it is to sell.
Right. So, anecdotally, we hear from, I've heard from a lot of, well, we'll talk about builders in in 1 minute, because that's affecting the supply too. But we're in such a low supply of homes. We were already, I've heard some numbers thrown around that we're 3.5 million homes low. We've got builder or undersupplied. We've got builders that are going to be about 20 or 25% under where they were last year or where they were headed this year on building new homes on those those new home builds. And so that's just creating more of a demand. We have a record number of millennials that are going into family, getting married and having kids age. And some of that's being affected by this. And we won't know until we really look back to see how that's being affected. But then we even go deeper. We have people wanting to move out of the cities into, more suburban, like we were talking about earlier, hipsterbia type areas. So all of those things, what I try to explain to a lot of people too is great or not great. Unfortunately, there are going to be a decent amount of foreclosures and defaults. We don't know how many, because we don't know how long the lockdown and this is going to really last. The longer it lasts, the more job losses there are, the more defaults are going to be down in that 6 to 12 month period. But there is so much demand and there's such a shortage of housing and there is so much money on the sidelines with these institutional funds, small investors that are ready to buy. So what I see and what we're doing on a daily basis is that we've got funds that are really trying to figure out where the market is now. And a lot of people that are selling now are selling a little bit more of a discount, but that doesn't mean the values are going down. Those are more one-time sellers that need to sell now, and so they'll sell at that discount. But I don't think that's going to affect the overall values that much. But if values start to go down in certain markets, there is such a demand of investors to buy, to put people in who need housing. And I think that even rentals become more prevalent, because if there are going to be more foreclosures, those people are out of the housing market or out of the home buying market for a certain period of time, and they're going to want to rent homes. They're not going to go from living in a single family home that gets foreclosed and moving into an apartment very often. They're mostly going to move into another single family home that they rent that's just more affordable. So I think the byproduct of this as well is that you're going to have more, I hope, and I feel like I'm seeing it, that builders are shifting to that more affordable product. So it's going to create more affordable homes out there, because a rental house, and this is what some people, I've tried to explain, and a lot of people listening probably already know this, that house can also be a home that somebody could to buy and live in at some point. So if it's an affordable house now and they can make that affordable house, that's going to cover both sides of the market as far as the home buying market and the rental market. And so, that's some of the stuff we're seeing.
I tend to agree. I think there's a lot of good reasons to be optimistic about housing. The demographics are such that the demand for housing is increasing these years as millennials age into their peak home buying age, and the shortage of housing, let's call it the sluggish recovery since the last boom of housing construction that never actually reached its previous levels, is creating a shortage. And that bodes well for housing as we go into this new era. The question really is, how deep will the economic pain be as a result of all this? If we're looking at something I've heard called the checkmark recovery, where once
or the swoosh, yeah,
the swoosh, exactly, where you've got some larger amount of people being hired back or retrieved from furlough in the short term, and then you've got some gradual recovery of the rest. How large that initial hire back is will largely determine whether we're looking at a mild recession or at a deep depression as a result of all this. And those two scenarios are very different in terms of what they mean for housing demand. I think if we are looking at a 10-year depression, housing will suffer too, but housing is likely to be one of the sectors that suffers the least. And one parting thought on that is, of all the things you could spend money on these days, the one essential that people are going to continue spending money on is their homes. When you shelter in place, that is the main thing you're buying.
Yeah, that makes sense. 100%. I think the house that people live in is becoming more and more important, especially with more people working from home, and it's becoming more acceptable. We're seeing, uh, I don't know the exact numbers, but we as a company were more efficient in the short term with people working from home. I fear though that this is such an interesting time because, for example, my wife and I both work from home. We've got 2 kids here, so now we're kind of working 7 days a week because we're having to spend time during our work week to tend to to help our kids with schooling and just to be there for them. And so that means we're working on Saturdays and Sundays on our jobs. So there's a burnout factor. You have to be careful of people getting too burned out because they're always on. I think the other thing too is that I've seen some of the numbers where it's something where 87% of all mortgages have more than 20% equity, or they did pre-COVID. So that is something that's interesting as well, because you're not seeing this event where you have mass amounts of value going down and people are underwater with their house and they can't sell them. So now they're having to do short sales or they're walking away. In this situation, a lot of the people that we've talked to and a lot of people I've talked to are seeing that there's a lot of people waiting on the sidelines to sell. They've got equity in their house. They can, if they need to sell quick, they can lower the price enough that they have still room to do that, and they can still have an event where they're earning some income, and they're not over. The banks stopping the HELOC loans and upping their guidelines, I think is a good thing. That's a sign of the banks looking at the market going, okay, we need to put the brakes on this because we don't want everybody to go take out HELOC loans to survive. And now their houses are going to be underwater if there's any kind of a deviation in value in submarkets. And so I feel that a lot of the people who may need to sell, whether they've lost their job and now they can't afford that. They can't afford the $3,000 a month mortgage, but they can figure something out for $1,500. They can sell their house, downsize into something more affordable if it's available. And so I think that those are all positive factors, right? Also, I mean, what is your thought? And I've debated some people on this and heard some different things on a lot of the initial job losses were more in the service industry and people who weren't necessarily buying or living in a single family home to own. A lot of them are renting. A lot of, anecdotal. You can talk about, people working in restaurants, hotels. So, but as this goes longer, you have more job losses in the upper tiers, and that's going to affect things. And so, it's all just fascinating.
Two thoughts on that. The one is you can really tell how the behavior from lenders and banks has changed. However rigid they were in 2008 and 2009, now they seem to have learned their lesson. The fact that we have forbearance being offered so soon, and the fact that banks are saying, let's try and bend as this wind blows us instead of staying rigid and breaking,
right,
is going to make things look different. Second thought is, as you mentioned, the economic impact so far have been very much skewed towards the rental sector, in the sense that those employees who are disproportionately losing their jobs are relatively lower income and are concentrated in the rental sector. They're causing a harder hit in the rental sector and housing than they are in the for sale sector. And I think the real vulnerability here is probably not going to be among individual homeowners, but among landlords of different sizes and different types. And it's going to be those who are particularly highly leveraged who are going to be the most vulnerable and will have the most problems in the short to medium term. As you alluded to before, I think people are still paying their rents at the moment, and either forbearance agreements or stimulus checks or PPP money that their employers might be getting are helping them keep their pay to a larger extent. But as time goes by, more and more people are likely to have issues paying rents, and we'll start seeing which landlords are more leveraged and can't make it once they start seeing.
Yeah, it's going to be interesting with the smaller landlords. I mean, in the single family rental business, it's the majority of them are people that own less than 5 homes. And so the institutional investors are insulated in a different way than the small investor who've, you own two homes and you have two tenants that say they don't pay, you're in trouble very quickly. And so you're going to see more of a shift there to some of the bigger investors, I think. But yeah, I especially in the multifamily, especially in commercial. I know some people that own commercial properties, office buildings in Chicago, and they're in big trouble. It'd be interesting to see how that all plays out. But I had this conversation with Chris Whalen. What's your opinion on bailout versus restructure? Because I see a lot of the bailout side of things where let's bail out the airlines, let's bail out, different sectors instead of letting them kind of feel the pain and restructure and sometimes come out better with less of a government stake. I mean, I guess that's a matter of opinion, but curious on what your thoughts are.
I mean, I think we're going through a period of temporary hardship, right? People will resume flying at some point. At some point, this pandemic will be behind us, and there'll be, herd in 20 years' time, there will be herd immunity, and we're not going to be in the midst of a pandemic. In 2 or 3 years, we might still be, but at some point, people will return to flying and return to using hotels and return to doing everything the way they used to, or largely the way they used to. And the question is, who has the ability to hold their financial breath long enough to make it past that? Yep. Some things we don't want to lose, and if they go under, if they go bankrupt, they may never return, and that is a justification for bailout to help those whose pockets aren't deep enough to survive this period. I think thinking of this in Darwinistic terms, those who can survive these hard times are the ones who are most worthy. Is ignoring the fact that there's a lot of luck in life and in corporate life as well, and how deep your pockets are at some point has more to do with when your business was born and what background you're coming from and how you choose to finance it,
right,
than how good your business is in other ways.
Yeah, I agree. And a lot of people on Main Street look at the larger corporations that are having to get bailed out that spent so much money on stock buybacks and they weren't reinvesting into their own balance sheets and their own businesses. And so I think there's on the masses, there's less sympathy towards that. For the small business owner who's sitting there struggling and unless they change the PPP loan criteria or issues, that there's a lot of people that it's not going to help them because this is lasting much longer. That PPP loan said 8 weeks. Well, it's going past 8 weeks. And so these people need help, especially restaurant owners are in a lot of trouble because they have low margins, very, very low margins. And there's a lot of restaurants that are going to go away and probably not come back maybe over the years, but especially in the smaller cities. So where I live in a smaller city, some of these people will lose their business and there's not going to be somebody to replace it because there's just not the demand, not as much demand as there is in a larger city. So I want to show just some of our numbers and just kind of go through that real quick on our rent collection numbers, because I want to get into some of the other things we've been talking about, some of the things that you've been talking about. We've got some questions that have come in about markets and the differences in the markets and the correlations or non-correlations with markets, because you can't, this is something that's hit the entire country. You can't just say every market's the same. Different markets have different dynamics and rely on different things. For example, where I live it's 70% tourism, even though 35% of the people that live in Steamboat Springs are remote workers. So that's great. The second home market's getting crushed, but people who live here don't actually mind that because the values were getting pushed so high from the Airbnb owners that they wouldn't mind a little softening in the local market. But then the economy itself is getting crushed. So I'm going to pull up some of these real quick. Let me switch my screen. But the dynamics are so it's just so interesting to see. Let's see if I can do this. There we go. So this slide right here are our leads coming into our website. These are leads of landlords who want property management or possibly even tenants who are looking for a place to live. And you can kind of see where pre-COVID we're up, pretty good there, and then everything just took a dive, and then gradually came up. And that, for us, we'd look at that as because people need places to live. We're running out of houses to rent, and there's so much demand. We're getting multiple qualified tenants for each house. And if that's not a promo to build more affordable housing, especially for these builders and investors to hit those affordable markets, you've got tenants who I believe are, if not more qualified or just as qualified pre-COVID. They're looking for longer term leases, 18, 24 months. And we've also seen our renewals jump up because people living in a house, they just want to they want to cross housing off their list of worries, and they want to worry about everything else. We're seeing more tenants that maybe say they can't pay the higher rent and want to move downsize to a smaller rental home or smaller rent costs. And so anecdotally, I've talked to a lot of funds who feel like they're getting more qualified tenants for their rentals. The question is, what happens to the people who are displaced in the lower band of the rent? Where are they going to go, and what's kind of government subsidies? Which I want to get your thought on that here in a minute, because that's an interesting thing that people aren't thinking about as much, or some people are. Let's see. Yep, this came in. All right. Here is, this is our showings scheduled, showings conducted. So we're right in there. It's still a little bit below where we were, but we're showing scheduled is high. That's a lot of people out there. I mean, we're hitting numbers that we haven't hit in the entire year of people wanting to see houses. And then the actual showing conducted is pretty strong. And it just goes to show, again, how many people are really wanting to get out there and find a house. And I think this is also going to mirror the demand for people to buy houses as well. Most of our tenants, most of the people that are looking for a house to rent are also dual tracking, looking for a house to buy. And that's been the case for a couple of years now, that we were getting a lot of people who have decided to rent a house because they couldn't find a house to buy. And then this is just our applications. So we're right up there where we were pre-COVID. And our applications really only dipped down a little bit, applications per week. And this is across about 22,000 homes that we manage. So the point is the demand is there. But I'm curious on what your thoughts are and what the government policy is going to be, on the, I don't want to say Section 8 housing. And we've talked to a couple of investors who are really starting to focus in that realm, not what you would think of the urbanized, multifamily. So I'm sorry. The first thing I posted was just our tenant leads on the leads. By the way, somebody just notified me, but the suburban subsidized housing, which Section 8 sometimes gets a stigma, but there's a lot of good quality tenants that are getting government subsidized housings that are able to live in suburban areas. And there's going to be more demand for that. What are your thoughts on that? As there's been a displacement. So there's a clear displacement that's going to happen. Some people are not going to be able to afford to pay their rent. And that's all going to come to a head when these eviction moratoriums and all of that happens. I mean, look, you're asking landlords not to charge rent, and they can get a forbearance on the mortgage that they must pay back, but you've got renters who aren't going to be able to pay that back. And there's no part of a collection that's going to help them. And in fact, going after those tenants and having an eviction on their and collections on their credit is going to hurt them from being able to rent in the future as well. So that is, what are your thoughts there?
So I have two thoughts. I think some of the pain is going to be borne by landlords who are prevented from evicting a tenant and who aren't getting paid and will have to somehow make do. And that's going to happen, probably more in the earlier phase than the later phase. Down the line, I imagine there can't be a moratorium on evictions permanently. And as some more affluent tenants gradually shift either from home ownership dreams down to rental, or from higher end rental to lower end rental, there will be folks who are squeezed out and unable to afford their low end rentals. That's not going to show up in people it will show up in higher rates of homelessness, but I think the major thing it will do is cause people to double up. If we track measures of how many people are living in doubled up households, where the numbers of residents per home are increasing, we're going to see an increase in the coming months and years. There's just no other way. People will turn to their social networks, to their family, to their friends, and those will have a heart and let them in.
Yeah, I agree with you. There's going to be, you just can't avoid it on some of the displacement that we're going to see and issues. I've got a couple of questions here. Some people are talking about the secondary markets in multifamily financing and single family rentals. And also I want to talk about the loan market in general for homeowners. We're seeing on single family rentals, the markets start to unstick and some very measured approach taken by the lenders to lend to investors. The larger funds, some of the really bigger funds pause buying, but the mid-cap private equity, private funds, they're buying. I mean, there are clients, we're buying houses. Now they've put a discount into the market. So I think it was more of, when this all started, everybody went, okay, this is all going down. Values are going to go down, even the funds. And they either stopped or they said, we'll buy at a larger discount. That discount's getting less. And they're starting to figure out that because of the housing shortage supply, there's not much of a discount to be had as an investor out there in the market. So that's something that I want to put out there to everybody, is that if you think you're going to be able to buy deals at 70% of value, it's unless you're buying maybe some multifamily, which there's going to be some opportunities there. On the single family, it's just that discount's not there. There are some builders who are looking for liquidity and they're willing to discount some of their homes, but not many. On the lending side, on the home owner occupied lending side, anecdotally, a lot of the builders I've talked to, it's the community banks are offering Fannie Mae, FHA loans at 4%, 4.5% with 3% down, and sometimes 100% financing still right now. The larger banks have pulled back and up their overlays on their credit and required much more stringent guidelines, but the federal government backed loans, they haven't changed their guidelines too much. And so there's still a flow to be able to get lending. And that's what we're seeing with these banks on non-jumbo mortgage, traditional agency backed loans. You can still go out there and get them. On jumbo loans, it's not great at all. And that's like a market where I live. You can't get a jumbo loan here. It's very difficult. Joe Vesey, he's asking about, and let's get into this next, the differences in markets. And you've got some slides that we might want to show, or let me know when you're ready to show them. But he was talking about how different markets are going to perform. And as I mentioned before, it's all different. In a market where I live, it's getting crushed because it's a tourism market. Can you give some examples of where, because I know you've been doing some research and I know it's not ready for public consumption yet, but talking about the changes, the difference between markets. And do you see any markets that you can just give an example that have some correlation in their housing markets and some markets that are no longer correlated that maybe were correlated before?
Sorry, I missed the last word. Something might have gone silent there.
Okay. Can you hear me now?
Yeah.
Okay. So I was talking about, do you see any correlation in markets, any differences? Just give your thoughts on how this is going to affect different markets. And if you see some markets that are now correlated together that weren't, or that were correlated before that aren't now. Does that make sense?
Yeah. So I'm going to break this down into three just because three is a good number. One factor is the industrial mix in different metros. So metros that are very heavily focused on tourism, hospitality, and such are going to take a bigger hit than others. In Vegas, that's an issue. In the Bay Area, it's less of an issue. In New York, it's also less of an issue. That is going to gradually become less important as the economic impacts shift from the immediately impacted industries to the general reduction in demand as layers of economic activity pile on. We're going to shift from very industry focused pain right now to much broader, dulled out or spread out pain. A second factor here is how able places are to continue functioning as they work from as people work from home. So if we're going to be doing this kind of yo-yo movement between sheltering in place and opening up and sheltering again as things get worse and back and forth for a couple of years, those places that are least susceptible to that kind of pain are the places where a greater share of workers are able to work from home. And that again has to do with the industrial mix. So places that are more educated in general, think DC and New York and the Northeast, and think your big tech hubs on the West Coast, those places are better positioned to have a greater share of employees work from home. And that will, to some extent, dull their pain as well. A third factor here has to do with how deep pockets are in different places. In a city where your typical business is a smaller business with thinner margins and just pockets that aren't as deep, you're more likely to see lasting trouble as businesses go under and employment remains below previous levels. In places like Wall Street or like the Bay Area, where you've got 5 tech companies that could keep paying their employees for 100 years without going bankrupt and without bringing in a dime. In those places, you've got deep-pocketed employers that will continue supporting employment and pay and wages. And those places are, as a result, a shade less susceptible to economic pain than other parts of the country.
So how do you so 2 questions to that. And this is a great thing to talk about migration patterns as well. How does, and I guess, we may not know until we look back, but how does the migration, the change of people wanting to move to some of these smaller, more, what I call that hipsterbia type communities, how does that change things? And how do you think the local health policy will affect this? Because some are saying just open it up and whatever happens, happens. And then the opposite side of that says, yeah, go ahead and do that. You're going to get crushed. And then some people are kind of in between. I'm kind of in between. I don't believe that we can just keep our kids and everybody just socially isolated for a whole long time. I can work from home, but eventually it'll affect my job, being, the economy will affect things. So how do you think about those 2 things? The migration of people migrating to some of these places that maybe previously couldn't handle this type of economic distress. So maybe that'll raise them up. And then specifically social policy or social health policy.
So the health policy is harder because it's more inherently short-term, less predictable. I don't, and migration patterns are something slow. They evolve over time. They take many years to create results. You get a little bit of movement each year, and it only adds up over decades. So I don't know how important a factor that is. If anything, it's going to make people in, let's call it the more conservative public health-wise parts of the country, those parts of the country that are more protective and more likely to keep shelter in place in action longer, it might make residents of those areas more reticent to move elsewhere, but I don't know that that's a major factor. I can tell you that the migration from the more expensive coastal cities, especially on the West Coast, tends to fluctuate with housing prices. When housing in California gets more expensive, the outflow of domestic migrants from the state to other parts of the country becomes stronger, and you tend to see more negative net domestic migration. When prices fluctuate downwards in those areas, think 2008, 2009, and perhaps in our future, that kind of dulls outward migration. And I think as economic pain settles in, whether or not that affects housing prices, we don't know yet. But I suspect that the impacts for the ability of people to find jobs are going to be worse in those parts of the country that are currently more affordable. And you'll have a better chance of finding jobs and more jobs reemerging in those expensive coastal cities. So ironically, this is actually likely to slow down out migration from the expensive coastal cities in my mind. It's going to make people more likely to stay in California and to stay in the expensive cities in the Northeast as well.
Interesting. And there was already that people chasing the more affordable markets, and there's a subset of people that doesn't matter to. But I think that some of these great markets has really opened themselves up to business, and it was already happening. People are already going to growing these hipsterbia type areas. So that's interesting. And on the social side, yeah, it's this is the health side. It's nobody knows what's going to happen, right? We can predict as much as we want, but this isn't solved, and so there's going to be some kind of happy medium or unhappy medium maybe.
There's an interesting point that crops up here, though. Some parts of the country have kind of a secret export industry that keeps them alive, right? If you look at Vegas and Phoenix and maybe Boise or Portland, a lot of the economic activity in those areas is driven by folks leaving more expensive parts of the country, moving there,
Right.
and bringing with them, wealth deposits that remain after they sell their homes. If that kind of migration slows down, that could hurt the economies in those places.
Interesting. Yeah, that's really interesting. And yeah, it's just so interesting to see all this play out, so I appreciate your time. So we have these slides. Do you want to preface this so we can
Sure.
talk about this, and I'll set the screen up while you do that.
Sure. So I think the tie into the bigger conversation is hipsterbia. We've seen a really deep sea change in how American cities build housing over the last 60 or 70 years. It used to be the case that American cities built a lot of single family homes on their outskirts and gradually densified their interiors. They used to tear down single family homes, build smaller apartment buildings, and when those areas became expensive enough, they'd tear down small apartment buildings and build bigger ones in their place. The city used to grow organically. That's no longer the case. Right now, we have something that I call a pattern of islands of density in a sea of no growth. We have cities that are still building suburban subdivisions out in the exurbs. Let me start over, given that the map's on the screen. Okay, this map is showing us the greater LA region, and it's showing us what the dominant type of new housing was that was built in each area during the 40s and 50s in this case. So the light blue marks single family homes, and that means that the vast majority of greater LA was mostly producing homes in the form of single family homes. The orange areas are what's called missing middle today. These are 2 to 49 unit apartment buildings. And you can see that between downtown and Santa Monica, there's a strip of missing middle being built in those 2 decades. And the red spots that you can see in downtown LA and in a couple other spots are clusters of 50 plus unit buildings where you have very large apartment buildings or complexes. If you can shift forward a slide, we can see what happened in the 60s and 70s. What you're going to see in a moment is that orange starts taking over the map. The 60s and 70s were peak missing middle. You had a much larger swath of greater LA produced apartment buildings, especially on the west side. You also see a few more of these red spots cropping up where you have clusters of large apartment buildings. And you start seeing these dark blue spots, which are areas that produce almost no new housing. If you move forward another 20 years, we'll see what happened in the 80s and 90s.
And so this has happened all over the country, though, right? In these urban areas.
Yes, LA is just an example. What I'm showing you now crops up in Detroit, and it crops up in Dallas and Atlanta and New York and everywhere. So by the 80s and 90s, you can see that the orange is receding. You've got these dark blue areas of no new construction cropping up much more often, and you've got more of these red clusters. And that reaches its most extreme in the last 20 years. If you can shift one more forward, you'll see what I call islands of density in a sea of no growth. You've got a map that is almost entirely dark blue, areas that have just gone cold in terms of producing new housing. They're built up in the single family subdivision, low density built up sense. And what new construction is happening is either out in the Inland Empire where there's still new subdivisions cropping up, or in these red clusters of large multifamily, which are kind of akin to what you've been calling hipsterbia, right? These are suburban clusters of large apartment buildings, either in places that are near transit or in places that were formerly commercial and are changing form towards being residential. Basically, those areas where you don't get as much NIMBY resistance and where you can build a 100-unit structure today. And that's where the action has been for the last few years.
How will this map look in 20 years from now or 10 years from now?
That's a really good question and a really hard one to answer. I want to hope that people's fear of um, greater housing density is temporary. I know that that fear is not necessarily well founded, because having higher housing density doesn't mean overcrowding inside units, which is what really matters from a health perspective. It actually means the opposite. But I worry that there could be a backlash against it.
Yeah, so that's actually an interesting point, because I'm sure you follow this. How, like Minneapolis, for example, said you can build whatever on. They took away just the single family rent or single family home restriction on lots, um, and that's happening in Oregon and other couple of places, and everybody has a different opinion on it. Tell me why you think that's a good thing, or why you think it's bad, and what does it mean? I think for me it means more affordability, because you get too many of these areas where you've got high end homes, and the people who service those areas that work there can't live there. They have to be commute in order to be able to work in these areas, and so um, I think that there's just a shortage of housing in those areas, and so that could, so a point for it would be, that it helps build more affordable housing, and it's not that bad for the neighborhoods.
I agree with everything you said. I think there should be no doubt that there's a huge shortage of housing in the expensive coastal cities. Those areas need to accommodate more people. They need to grow. There just need to be more people able to live in those cities. The question then becomes, how do you provide that housing? Do you continue sprawling? Do you continue building in these islands of density, or do you gradually, modestly densify single family areas by allowing people to build additional auxiliary dwelling units, ADUs, or in-law units, or by building small multifamily structures? Now, what's happened in Minneapolis and in Oregon and in California, though much more quietly beneath the radar, is a quiet YIMBY revolution for building more housing. Now, the distinctions between building more in these islands of density versus the modest densification of single family tracts is twofold. One aspect, a very important one, is the one you mentioned, which is by spreading this housing across an entire area, you can often allow the housing to happen in those places that people want it. So rather than forcing people who are on the cusp of homeownership to look for apartments that are typically rentals in these islands of density, they can seek something that's much more similar to their single-family homeownership dream. Okay, a unit, an ADU, or part of a quadplex might not be quite the same as a single-family home, but it's a whole lot closer than a unit in a 100-unit building.
Right.
You're kind of offering this middle ground by doing this, which you aren't in the islands of density, and you're potentially getting people closer to jobs, although that varies from place to place.
It does, and the sprawl was something that you mentioned that I think is important, and what we've seen when we're talking with single family rental investors and looking at deals from home builders, the market for in that investing is not in the suburban sprawl track housing, a la Phoenix 2008, right? Where it's just thousands of the same home just spread out in that sprawl. And I think that's, for one, I don't think that's great for the local economy, because people aren't spending money where they live, and people aren't really as interested in living in that type of housing. They want some, and that's where that hipsterbia comes in. They want that live, play, and even possibly work environment that they can thrive in, and is good for families. And I saw something recently came out that was saying, before people only wanted to be before remote working, people wanted to be no more than 20, 25 minutes from their work. Now they're willing to be 45 minutes to an hour if they can work from home a certain period of time. And time will only tell how that will work, because I've seen, the remote work has been tried and not works for some companies, works for others, and all that kind of stuff. But the other thing is, and this is a question from Chris Mulhern, online was that, do we think we'll see a higher demand for single family rentals from those tenants renting luxury multifamily in markets like Denver for the amenity of social distance? And I think the answer would be yes. So a lot of people are paying a lot of money to live in a dense area around a lot of people, and they're realizing that they can just go a little bit further out and live for less and have more. And I think that's naturally going to happen. I believe the other thing that's happening that I'm seeing is that, a lot of the job losses in the restaurant, hotels, service industry were a lot of younger workers that that have temporarily moved back to where their family is, and they're finding that these are areas that aren't that bad, and if they could stay there, they're going to, just with the climate of things. So time will only tell with that, but I don't know if you have any final thoughts there.
Well, I think all that's true. I think the motivations for being more open to low density single family living instead of apartments are going to change over time. I think in the short term, there are the health fears and the need to have a bit more space as you shelter in place, and those things might drive some people towards the suburbs in the near term. I think what's more important a few years down the line is what happens to where people work. And I think we will see some reversion to working from the office. I don't think working from home to the max the way it's happening now is going to persist, but I'm sure that things won't revert entirely back, in the sense that firms will realize they can save on their real estate costs, and they'll realize that things can work when people work remotely several days a week, or to some limited extent, or in some departments. So I think working from home will remain at much elevated levels compared to pre-COVID, even after sheltering in place is done. And that will prompt people to care a lot more about their home environment, about having that extra space, because they're going to be in their homes a lot more. And that's going to cause some lasting shift in demand away from large multifamily to single family homes. Having said that, I think people love the city, and people will continue to love the city. I don't think large multifamily and vibrant walkable areas is going away. I think it's going to take a modest hit.
Yeah, I agree. I think Luke Burton asked about attached dwelling units creating parking issues. Is that just a municipality issue they have to figure out if they're going to build more density, or will they need as many people need the cars?
I think it's too soon to say what this will do to traffic and the need for cars in general. I think there should be no doubt that modest densification of single family areas will cause more traffic, and it will impose new infrastructure needs on cities. But I don't think that that's a sufficient reason not to go that route, right? Because the alternative is not building; it's building even farther out, or in metros where people are going to be even more car dependent. So that kind of NIMBY argument fails when you think about things holistically.
Yep, I agree. All right, I think that's pretty much it. Do you have any final thoughts? How do people get in touch with you? What is your value prop that you offer if a fund or anybody wants to use your services? Can you outline that real quick?
Yeah, so I do data work as an economist. I've taught econometrics at Berkeley. If you have a targeted question, you want to know what is going to happen in the office space and what it means for this metro or that metro, or any question that is sufficiently targeted, and you want someone to give you a proper, grounded answer that comes from the data and from proper analysis, come find me. My email is issi@metrosite.com, and you can see some testimonials on the website.
Yeah, and also Issy's tagged in the LinkedIn Live. You can connect with him on LinkedIn. You can, I think that we're looking at wanting, and something that Issy and I are going to talk about offline, and maybe understanding some different markets that could grow and be very strong in the new post-COVID or current COVID world, whatever you want to call it. So I think that's some, if you're an investor and you're wanting to look at markets, and I think, you can get some pretty good data from Issy on that as well. So Issy, I really appreciate you coming on. We're going to log off. I'm going to do a quick goodbye to everybody. And, we'll have to do this again because things are changing so quickly. The interview I did with RC Whalen a couple, like a month ago, everything we talked about has changed. So um, we'll have to do this again and maybe give some like monthly updates on where you're seeing things and stuff like that. So I really, really, really appreciate you coming on. Um, have a have a good day and stay safe, as everybody says. And I will talk to you soon. I really appreciate it.
Thanks for having me on. It was a pleasure.
Yeah, you bet. All right. So appreciate you listening to my show. If you have any comments, questions, you disagree with anything that I've said, I'd love to hear it. I'd love to debate these things and understand this. If you're looking to connect with me, you're watching this probably on LinkedIn. You can connect with me very easily. We advise not only in property management and managing homes, but we also advise funds on where they should be buying and the strategy that they should be buying houses and even procure those transactions for them. So if you're interested to know more about single family rental investing and you're newer to the space, go to renterswarehouse.com, go to our education center, and there is a ton of data and information and free education about real estate investing. I've lived by the mantra that we should give away as much as I can and give away my knowledge as much as possible and live by the growth mindset. So I really appreciate you joining the show. And this show will be available to watch again, to share out. I will share it out. The comments in LinkedIn Live do not work that great. So I'm going to post a quick video in a few hours of just my thoughts about the show and attach the link to the show, and then people can comment there. So I appreciate you coming, and look for another show in the next week or so. Thank you.